They just raised margin requirements, again, right before March delivery. And if you understand what that actually means, you'd realize this isn't risk management, this is damage control. Because right now, there are 400 million ounces sitting in open interest, and the registered inventory that's supposed to back those contracts, it's collapsing. Not slowly, fast. And what nobody's telling you is that the math stopped working 3 weeks ago, but the machine kept running anyway. So here's the question they don't want you asking. What happens when the contracts come due and the metal isn't there? Welcome to Currency Archive. Now, if you've been with us before, you know we do not waste your time with hype. We give you the institutional view they do not broadcast on financial television. And if this is your first time here, do yourself a favor. Hit that subscribe button. Not because we're asking for a favor, but because what's unfolding right now in the silver market is the kind of thing you'll want documented step by step as it happens. Also, drop a comment and let us know, where in the world are you watching this from? Because this story isn't just American, it's global, and I want to know how far this warning is traveling. On February 6th, 2026, the CME Group made an announcement that most people scrolled past without a second thought. They were raising margin requirements on silver futures contracts. Again. The official reason, posted in dry regulatory language on their website, was standard risk management protocol. But anyone who understood what was actually happening in the silver market that week knew this was not routine. This was an emergency brake being pulled on a system that was already shaking. Margin requirements are the deposits traders must put up to hold futures positions. When the exchange raises those requirements, it means traders need more cash up front to maintain the same positions. The official logic is simple. Higher volatility requires higher collateral. But there is another effect that matters more. When margin requirements jump suddenly, it forces smaller traders and speculators out of the market. They cannot afford the new deposit levels, so they close their positions. This reduces open interest, it reduces delivery pressure, it cools the market down. Except this time, the timing was different. March delivery was less than 3 weeks away, and the traders who were standing for delivery were not small speculators gambling on price moves. They were institutions, funds, and possibly sovereign entities who wanted the physical metal. Raising margins at this stage would not scare them off. It would only confirm what they already suspected. The system was under stress. The numbers told a story that the official statements did not. As of early February 2026, open interest in March silver futures sat at approximately 400 million ounces. That means 400 million ounces worth of contracts were still active, with delivery obligations approaching fast. In a normal market cycle, most of those contracts would roll forward into later months. Traders would close March positions and open April or May contracts, pushing the obligation down the road. That is how the futures market usually works. It is a pricing mechanism, not a delivery mechanism. But March 2026 was not behaving normally. A significant portion of those contract holders were not rolling. They were standing for delivery. They wanted the metal. Now, here is where the mathematics become uncomfortable. The COMEX warehouse system, which is supposed to back these contracts, operates on two inventory categories, eligible and registered. Eligible inventory is metal stored in approved warehouses, but not currently available for delivery against futures contracts. Registered inventory is metal that has been specifically allocated and made available for delivery. Only registered inventory matters when contracts come due, and registered silver inventory had been falling, fast. In January 2025, registered inventory stood above 80 million ounces. By February 2026, it had dropped below 45 million ounces. Some weeks saw drawdowns of several million ounces in just days. The metal was leaving the system, moving from registered to eligible status, or disappearing from warehouses entirely. Meanwhile, open interest kept climbing. More contracts, less metal. The math was straightforward and disturbing. If even 15% of March open interest stood for delivery, that would represent roughly 60 million ounces of demand. But registered inventory was sitting at 45 million ounces. The system did not have enough metal to satisfy full delivery if the demand materialized. This is where the margin increase becomes more than a technical adjustment. When the exchange raises margins right before delivery month, it sends a message. It tells the market, we see the pressure and we are taking steps to manage it. But it also reveals something uncomfortable. If the system were functioning smoothly, if there were plenty of metal available and no delivery concerns, there would be no need for intervention. The fact that intervention happened suggested the opposite. There is another detail that made this moment different from past squeezes. Historically, when delivery pressure built up in silver, the solution was always the same, cash settlement. Long holders would be offered a financial settlement instead of physical delivery. Short sellers would pay a premium to close their positions without having to source metal. The crisis would resolve itself through price, not through physical transfer. But in February 2026, the conditions for that resolution were breaking down. Physical silver in Eastern markets was already trading at massive premiums over COMEX prices. In Dubai, spot silver was quoted above $120 per ounce, while COMEX was still below $75. That meant the traditional arbitrage mechanism, where traders could buy COMEX contracts and sell physical metal in premium markets, was not working. Why? Because taking delivery from COMEX had become uncertain. If the metal might not actually be there, the arbitrage trade became too risky. And if arbitrage was not working, the paper price and physical price were no longer connected. So when CME raised margins on February 6th, they were not just managing risk, they were trying to reduce delivery demand in a system that no longer had the inventory to meet it. The question was whether the intervention would work, or whether March would force the system to admit something it had avoided admitting for years, that the contracts had outgrown the metal. There's a mechanism that is supposed to prevent what was happening in February 2026. It does not require regulators, emergency meetings, or policy interventions. It is automatic. It is called arbitrage, and for decades it kept the global silver market functioning as one coherent system. When that mechanism stopped working, everything else started breaking. Here is how it used to work. Imagine silver is trading on COMEX in New York at $30 per ounce. At the same time, physical silver bars in Dubai are selling for $35 per ounce. That $5 gap is an opportunity. A trader buys a COMEX contract, takes delivery of physical metal, ships it to Dubai, and sells it for the higher price. The profit might only be $1 or $2 per ounce after costs, but multiply that across millions of ounces and it becomes significant. More importantly, this process does something critical. It pulls the two prices back together. As traders buy COMEX contracts, the paper price rises. As they sell physical metal in Dubai, the physical price falls. The gap closes. The system rebalances. This is not theory. This is how commodity markets have worked for over a century. Arbitrage is the invisible hand that keeps New York, London, Shanghai, and Dubai speaking the same language when it comes to price. It does not matter if one market opens higher or lower on any given day. Arbitrageurs move metal and capital until the prices converge. It is automatic. It is reliable. It is the foundation of global price discovery. Except in February 2026, it was not working anymore. Physical silver in Dubai was trading at $127 per ounce. COMEX spot was at $73. That is not a $5 gap. That is a $54 gap. That is a 74% premium. In a functioning market, that gap would trigger an avalanche of arbitrage trades. Every bank, every trading desk, every hedge fund with access to COMEX would be buying contracts, taking delivery, and shipping metal east. The profits would be enormous. The gap would close in days, maybe hours. But it was not closing, it was widening. Shanghai told the same story. Physical silver there was priced 60% above COMEX. Mumbai showed similar premiums. Across Asia and the Middle East, the metal itself was trading in a completely different reality than the paper contracts in New York. And the arbitrage traders who were supposed to connect those realities were sitting on the sidelines. Not because they did not see the opportunity, they saw it. Everyone saw it. They were not trading because the trade had become impossible. Three things had broken the arbitrage loop, and all three were happening at once. First, China had imposed export restrictions on refined silver in late 2025. The official reasoning involved strategic resource management and industrial policy. The practical effect was that roughly 70% of the world's refined silver supply was suddenly locked inside Chinese borders. It could still be sold domestically. It could still be used by Chinese manufacturers. But it could not flow freely to global markets. That meant a trader who bought COMEX silver and wanted to sell it in Shanghai faced a problem. The premium was high, but getting the metal into the market legally was nearly impossible. Second, COMEX registered inventory was collapsing. Even if a trader bought a contract with the intention of taking delivery, there was no guarantee the delivery would actually happen. If the warehouse system ran out of registered metal before your contract settled, you would be forced into cash settlement. And cash settlement at COMEX prices meant you could not capture the physical premium. The arbitrage trade only worked if you actually received the metal. Uncertainty about delivery killed the trade before it started. Third, the margin increases. Moving large quantities of physical silver requires significant capital. You have to buy the contracts, post the margin, take delivery, arrange shipping, insure the cargo, and finance the inventory while it is in transit. When CME raised margin requirements in early February, it made this capital structure more expensive. Traders who might have deployed $10 million into an arbitrage position now needed $15 million for the same exposure. And if the delivery was uncertain and the export channels were restricted, why take the risk? So the arbitrage stopped. And when arbitrage stops, markets decouple. This was not just a COMEX problem anymore. This was a breakdown in how silver was priced globally. Industrial users who had hedged their silver purchases using COMEX futures were discovering their hedges meant nothing. They had locked in a price of $75 per ounce on paper, But the physical metal they actually needed to run their factories was trading at $120. The hedge did not protect them. It gave them a false sense of security while the real cost exploded. Banks that had sold derivative contracts linked to silver prices were facing a different nightmare. Their models assumed that COMEX prices represented the actual cost of silver. If a client wanted to settle a contract, the bank could theoretically go into the market, buy metal at COMEX prices, and deliver it. But now the metal was not available at COMEX prices. It was available at prices 70% higher. The derivative contracts had become liabilities that could not be hedged using the underlying asset they were supposed to track. There was a deeper problem underneath all of this, and almost no one was talking about it yet. For decades, the financial system had treated silver as a globally fungible commodity. 1 ounce in New York was the same as 1 ounce in Dubai or Shanghai. The location did not matter because arbitrage ensured the price stayed aligned. But when arbitrage failed, silver stopped being one global market. It became regional markets with different prices, different supply conditions, and different rules. And if silver could fracture into regional markets, what did that mean for other commodities? What did it mean for oil, copper, or wheat? What did it mean for the entire architecture of commodity derivatives, futures markets, and price discovery mechanisms that global trade relied on? February 2026 was not showing a silver crisis. It was showing what happens when the assumption of global market integration breaks, and nobody had a plan for what came next. There is a question that nobody wanted to ask out loud in February 2026, but it was sitting in every risk committee meeting, every trading floor briefing, every regulatory back-channel conversation. The question was simple. Who is actually short this market, and what happens to them if March delivery goes wrong? Because the numbers floating around, the 400 million ounces in open interest, the collapsing registered inventory, those were abstract. They showed pressure in the system. But pressure does not cause crisis. People cause crisis. Institutions cause crisis. And somebody, somewhere, was holding a position that could not survive if the delivery mechanism failed. The short side of the silver market is not evenly distributed. It never is. Most commodity futures markets operate with a handful of major players holding the bulk of short exposure. These are typically bullion banks, large trading houses, and commodity-focused hedge funds. They sell contracts for a variety of reasons: hedging physical inventory, facilitating client trades, speculating on price declines, or managing complex derivative books. In normal conditions, this concentration is not a problem. The shorts can cover their positions by buying back contracts or delivering metal from inventory. The system absorbs it. But March 2026 was revealing that the short side had made an assumption that was no longer holding. They had assumed they could always settle in cash if physical delivery became inconvenient. They had assumed the exchange would step in with procedural adjustments if delivery demand spiked. They had assumed that physical silver, while occasionally tight, would never actually become unavailable at a reasonable premium. All three assumptions were breaking simultaneously. Regulatory filings and market positioning reports, which are published with a delay but still offer a directional picture, showed troubling concentration. A small number of entities held short positions that amounted to tens of millions of ounces each. Individually, those positions were manageable if the market stayed liquid and delivery stayed optional. But if multiple large shorts were forced to deliver at the same time, and if registered inventory was insufficient, the math stopped working. There was not enough metal in the system to satisfy everyone who might need it. Now, the natural question is, why did these institutions let themselves get into this position? Why did they not cover earlier when the warning signs were visible? The answer is that covering a large short position in a thin market can trigger the exact crisis you're trying to avoid. If a major bank starts buying back millions of ounces of silver contracts, the market notices. The price spikes. Other shorts panic and start covering too. The squeeze accelerates. What begins as a risk management decision turns into a forced liquidation event. So the institutions held their positions, hoping that March would resolve itself the way previous delivery months had resolved themselves, through rollovers, through cash settlements, through managed exits that did not require actual metal changing hands. But the long side was not cooperating this time. Traditionally, most futures traders are not interested in physical delivery. They are trading for price exposure, not metal. When delivery month approaches, they roll their positions forward or close them entirely. This keeps open interest fluid and prevents delivery bottlenecks. But March 2026 saw something different. A significant percentage of long contract holders were standing for delivery. They were not rolling, they were not closing, they wanted the metal. Who were they? The exact identities were not fully public, but the profile was clear. These were not retail speculators or momentum traders. These were institutions with balance sheets large enough to post delivery margin, arrange vault storage, and handle the logistics of receiving physical metal. Some were likely commodity trading advisors managing billions in assets. Some were hedge funds executing long-term macro strategies. And some, according to market rumors that could not be confirmed but also could not be dismissed, Were sovereign-linked entities or strategic reserve programs quietly accumulating physical silver while prices were still anchored to paper markets? This created a standoff. The shorts needed the longs to roll or cash settle. The longs wanted physical delivery. And the exchange, which was supposed to be a neutral facilitator, was caught in the middle with insufficient registered inventory to satisfy full delivery demand if it materialized. So what happens if delivery fails? Not in theory, but in practice? The mechanics are complex, but the outcome is binary. If COMEX cannot deliver metal against a contract, it defaults. The default can be managed through force majeure declarations, which are legal clauses that excuse non-performance due to extraordinary circumstances. The exchange could invoke force majeure, offer cash settlements at a formula-based price, and close the contracts without physical delivery. This has never happened in modern COMEX silver history, but the legal structure exists. The problem is that a force majeure event does not make the demand for silver disappear. It just shifts it. The institutions that wanted metal would still want metal. They would go to physical markets and pay whatever premium was necessary. The cash settlement they received from COMEX would not reflect the actual cost of acquiring silver in the real world. So they would take losses, or they would sue, or both. Meanwhile, the shorts who thought they were protected by the exchange's ability to force cash settlement would discover something uncomfortable. A force majeure that favors the short side destroys confidence in the contract. If traders believe that the exchange will simply cancel delivery obligations whenever the system is stressed, why would anyone use COMEX for price discovery? Why would industrial users hedge there? Why would long-term investors hold positions there? The market does not die from a single default. It dies from the loss of credibility that follows. There's also a contagion risk that extended beyond silver. Major banks that were short silver futures also held positions in gold, copper, platinum, and other commodity derivatives. If a silver delivery failure forced them to take unexpected losses or triggered margin calls, those pressures could spread to other books. A bank scrambling to cover silver shorts might have to liquidate positions in other markets to raise cash. That selling could trigger stops, amplify volatility, and pull other institutions into the turbulence. This was not speculation. This was how the 1998 long-term capital management crisis unfolded. A single hedge fund's collapse in one market radiated outward because the counterparties and creditors were interconnected. The 2008 financial crisis followed a similar pattern. Stress in subprime mortgages cascaded into investment banks, money markets, and the global credit system because the exposure was concentrated and the institutions were linked. Silver was smaller than subprime mortgages, but the principle was the same. Concentration plus stress plus interconnection equals systemic risk. By mid-February 2026, the institutional players knew this. The exchange knew this. The regulators knew this. What nobody knew was whether they could manage the situation quietly or whether March would force everything into the open. The positions were locked in. The inventory was what it was. The only variable left was time, and time was running out. There are moments in financial history when a single market event stops being about that market and becomes a referendum on something larger. March 2026, silver was becoming one of those moments, not because silver itself was systemically important to the global economy, but because what was happening in silver revealed a structural question that applied to everything. Do paper contracts still represent the things they claim to represent? For decades, the answer was yes. A futures contract for crude oil represented actual crude oil that could be delivered. A gold futures contract represented actual gold. A wheat contract represented actual wheat. The paper and the physical were connected through arbitrage, through delivery mechanisms, through the credibility of exchanges and clearinghouses. Traders knew that if they held a contract to expiration, they could either take delivery or settle at a price that reflected the cost of the physical commodity. That assumption was the foundation of modern commodity markets. It allowed producers to hedge. It allowed consumers to lock in prices. It allowed investors to gain exposure without handling physical goods. The entire system worked because everyone believed the connection between paper and physical was real. March 2026, silver was testing whether that belief still held. If COMEX resolved the delivery pressure through regulatory intervention, through forced cash settlements, through margin increases that pushed traders out of positions before delivery could occur, the immediate crisis would pass. The exchange would avoid default. The banks would avoid forced liquidation. March would come and go, and by April, the headlines would move on to something else. But the cost of that resolution would be credibility. Every industrial user watching the crisis would learn that COMEX prices did not reliably reflect the cost of obtaining physical silver. Every long-term investor would learn that holding a contract to delivery did not guarantee access to the underlying metal. Every trader would learn that the exchange could change the rules mid-game when the system came under stress. These lessons do not disappear just because the immediate crisis passes. They change behavior permanently. If industrial users could not trust COMEX for hedging, they would stop using it. They would negotiate direct supply contracts with miners and refiners, locking in physical delivery terms years in advance. That would pull liquidity out of the futures market. If investors could not trust that contracts represented real metal, they would shift capital into physical bullion, allocated storage, or equity positions in mining companies. That would reduce open interest and make the futures market thinner, more volatile, and less useful for everyone. In other words, a managed resolution might prevent a March default, but it would accelerate the very decoupling between paper and physical markets that the resolution was supposed to avoid. The second scenario was messier, but more honest: partial delivery failure. Some contracts settle physically, some are forced into cash settlement. Legal disputes follow. Prices in physical markets and paper markets diverge even further. The system does not collapse cleanly, it limps forward in a state of permanent distrust. This is actually closer to how most financial stress events resolve in practice. There's rarely a single dramatic collapse. Instead, there's a slow erosion of confidence, a gradual shift in behavior, a quiet exit of participants who no longer believe the market serves their needs. The market continues to exist. It posts prices every day, but fewer people use those prices to make real decisions. It becomes a shadow of what it once was. The third scenario, the one nobody wanted to speak about directly, but everyone was privately considering, was systemic delivery failure. Not just in March, but structurally. A recognition that the COMEX silver market had written more contracts than it could ever physically settle, and that the entire structure needed to be redesigned. This would require exchange rule changes, regulatory intervention, possibly even government involvement if the contagion threatened financial stability. History offered a reference point. In 1980, the Hunt brothers' attempt to corner the silver market led to emergency rule changes, forced liquidations, and a crisis that nearly brought down several brokerage firms. But that crisis was about price manipulation and leverage. This one was different. This was about supply. You cannot regulate physical metal into existence. You cannot force majeure your way out of a genuine shortage. If the world needed more silver than the world was producing, no amount of financial engineering would solve it. So what did this mean for the business community, for decision makers watching this unfold in real time? It meant that commodity exposure was no longer a purely financial decision. It was a supply chain decision. A company that relied on silver for manufacturing could not simply hedge price risk using futures contracts and assume the physical metal would be available when needed. They needed direct relationships with suppliers. They needed inventory buffers. They needed contingency plans for a world where financial hedges and physical procurement were separate problems. It meant that counterparty risk was back. For 2 decades, the financial system had operated under the assumption that major exchanges and clearinghouses were essentially riskless. They had capital buffers, regulatory oversight, and access to central bank support if needed. But those protections only worked if the underlying markets remained liquid and functional. If delivery mechanisms broke, if arbitrage failed, if paper and physical decoupled, the counterparty risk was not with the exchange. It was with the market structure itself. It meant that physical possession had value independent of price. Owning a futures contract that promised silver at $75 per ounce was not the same as owning physical silver, even if the contract said you could take delivery. The gap between promise and possession had widened into a chasm, and in an environment where delivery was uncertain, the physical metal carried a premium that no paper contract could replicate. And finally, it meant that this was not just about silver. Copper was seeing similar dynamics in China. Nickel had experienced a historic short squeeze in 2022 that forced the London Metal Exchange to cancel trades. Lithium markets were fragmenting between Chinese domestic prices and international prices. Natural gas in Europe had decoupled from US prices. Oil was increasingly traded in bilateral agreements that bypassed traditional benchmarks. The pattern was clear. Commodity markets were re-regionalizing. The era of seamless global price discovery, where one price in one location represented the value of a commodity everywhere, was ending. It was being replaced by a more fragmented system where geography, politics, and physical access mattered as much as financial capital. March 2026. Silver was not an isolated event. It was an early chapter in a larger story. A story about what happens when the financial system's abstractions, its derivatives, its futures contracts, its price indexes, collide with physical reality. When the paper says one thing and the metal says another, eventually the metal wins, not because it is more sophisticated or better regulated, but because it is real. The question was not whether March would cause a crisis. The question was whether the people making decisions in business, in finance, in policy would recognize what the crisis was actually revealing. Because if they treated it as a temporary disruption in one small market, they would miss the point entirely. It was increasingly clear it did not.